So many central banks around the world have entered a phase of monetary policy tightening on the back of a cocktail of risks, which include inflation, supply constraints, the spillovers of the global pandemic, and the Ukraine crisis, among others. For Nigeria, the interest rate tightening started in the month of May and may continue at the next meeting later next month. Let's have a conversation around this now as the director in charge of monetary policy at the Central Bank of Nigeria, Dr. Mahmud Hassan, joins us on the show. Thanks for coming through, Dr. Hassan. It's good to have you on the program tonight. Let's just hit the ground running very quickly. Should a change in monetary policy direction be expected as the central bank now pursues what you call a steady increase in interest rate?
Thank you, Watson, and good evening. Yes, the trend now is being that global inflation is still on the rise. We see the US already getting to about 10% in inflation, United Kingdom getting to 9%, Euro areas are also, started getting the rise in prices, largely driven by energy prices, commodity prices following the Russia-Ukraine war. And so you will see that translating to what is happening in emerging market and developing economies through imported inflation, through high value of the US dollar, through carry trade and capital flow reversals. So those channels will mean that for the Nigerian economy, there are still uncertainties, there are pent-up demand that is also pushing up inflation numbers. So the drivers of those, or the cause of the increase in rate was, one, substantially to tame inflation, and two, to also curtail the impact of the pent-up demand on aggregate domestic prices. For as long as those trends continue or intensify, I think monetary authorities will be wise to keep the tightened position. However, if those fundamentals change, then you start seeing a change in behavior. You see the United States has hiked rate, I think the fourth time now, getting to the fifth one, and there are promises that they are still going to be hiking rate this year. John Powell has already mentioned that the hiking rate or the drive to tame inflation is not going to slow, or is not likely to slow in the short to medium term, except the fundamentals change. So monetary authorities are looking away, in terms of trade-off on growth, GDP growth, to taming inflation, given the impact it has on welfare, it adds on output growth, and aggregate disposable income, the economy. So we see that still subsisting, and that is likely to influence the behavior of monetary authorities.
So inflation, well said, but inflation continued to rise. Would that impact monetary policy tools or effectiveness in the short to medium term for the Central Bank of Nigeria? Will it?
So for monetary policy to be optimally efficient or getting the expected targeted outcomes, it must be complemented by other policy measures, which has to do with trade, which has to do with fiscal, which has to do with the capital market, the investment side. You saw the numbers you just reeled out now, and behaviors of activities in the capital market. So it's a conglomerate of all those factors that will play out in terms of the effectiveness of monetary policy. The channel for monetary policy implementation is the financial system, particularly the banking sector. So for as long as that sector is fragile or unstable or having some systemic risk, then efficiency of monetary policy will be impacted. Monetary aggregate requires controlling the quantity of money within the system, and if a substantial part of those monies are outside of the banking system, then you see the potency of monetary policy playing out in that space. So as much as possible, the monetary authorities try to get a substantial part of this currency in circulation within the banking system, so that when we're able to mop up or control or release those resources, the signaling effect of monetary policy, to which is the MPR, will now have impact on credit expansion or credit slowdown in terms of exchange rate, in terms of appreciation or depreciation of the exchange rate, in terms of affecting a financial account from the external side. And so you see that also playing out in terms of taming this pent-up demand that I refer to in terms of growth in in the aggregate demand following the stimulus packages that were, injected into the economy post-COVID. That growth in demand was not compensated by a commensurate increase in supply, given the distortions that supply side distortions that have been, global, including domestic.
So when the U.S. Central Bank or the Federal Reserve Chairman says the fight against inflation is not over yet, what would that hawkish stance by the Central Bank in the U.S., what would it mean for frontier markets like Nigeria?
It will mean that the threat for capital outflows is still there. It will mean that the US dollar will still be appreciating against major trading partners of the US, including Nigeria. And that will mean some threats to depreciation for the naira, which also mean a dry out in credit, in the sense that substantial part of this inflows, either FPI or that came into Nigeria, dollar denominated, will start going back because of returns on investment is a lot higher now. In the US, stability is also there, so the risk premium is reduced. So if you see that those outflows, there are going to be demand pressure for FX. And you also know that there's a transmission between FX or depreciation of the naira and inflation, and that also feeds into other domestic prices. So the tightening is to tame that growth we're seeing. We're also mindful of the fact that tightening will also mean slowing down in credit growth, and that will mean slowing down in output growth. So it's a balancing act, such that the tightening does not necessarily slow down credit to the critical sectors of the economy, but it slows down the effect of the demand pull inflation within the economy. So the announcement by the US that it's still going to continue with that will mean this vulnerabilities. Nigeria is exposed to these vulnerabilities, and there's a need domestically to also start looking at how we can increase, our shock absorbers in order to reduce the systemic effect of these global shocks.
Okay, so when we talk about the growth of the GDP, the gross domestic product, tell me what role does the monetary policy play in advancing the growth of a country's GDP? In particular, let's bring it home to Nigeria.
Monetary policy is largely to address, short-term policy objectives, in the sense that it is supposed to ensure stable, low inflation, stable prices, domestic prices, including interest rate, exchange rate, and then the inflation of our goods and services, such that investment flows, are stable and consistent to drive output growth. Where you see that not taking place, so credit expansion is not taking place. So financing output growth is stalled. Exchange rate is not stable, such that cost of funds within that channel. Also, your export is not attractive to allow for incentives for the producers to go into export producing activities. And then you also see that return on investment in terms of money market instrument extending to capital market instrument are also not that attractive. So ensuring that price stability is very, very essential in these pockets of the Nigerian economy. Allowing that to subsist over a reasonable period of time, allow investors to plan, allow capital inflows to be consistent, whether it's also capital mobilization, domestic, either through savings or whatever means, is consistent to driving that output growth. So it's very critical that we get that. But like I said, it must be complemented by fiscal measures, trade measures, external sector measures, measures in the fixed income and the equities market. So it's a combination of all that will ensure the effectiveness of monetary policy.
All right, well, thank you so much tonight. I really appreciate this conversation. As always, Dr. Mahmud Hassan, Director in charge of Monetary Policy at the Central Bank of Nigeria. Thank you so much.